Let's also talk about some of the other pockets as well. We haven't been discussing IT so much. I wanted to again ask you, have things changed with the outlook on the IT sector of late? Because, globally, things still remain uncertain. Even though on a domestic footprint, we have our growth improving on the GDP front, we have our GST collections, which is on the rise, inflation, which is on a comfortable zone, rate cuts also further pushing for the economy to roll. Earnings have actually been on a better side this time around as well. So locally, there aren't too many problems as well as far as the global stage is concerned. And IT sector is the one which we always see as a mirror of what's happening in the US especially. How would you look at IT sector as of now, sir?
Yeah, you are absolutely right. For the same reasons, for the last 4 to 5 months, we have been speaking to our clients that focus on the domestic demand-driven sectors. You had a geopolitical tension, then you had a tariff war. All this would mean that it is better to look around opportunities within the Indian economy rather than looking outside. Still that uncertainty is there. So as you rightly mentioned, the inflation rate going down and, many other factors, which are all GDP growth, all are conducive for picking up domestic demand-driven sectors and businesses within the country rather than looking at large IT stocks. Because if you look at all the large IT stocks except Wipro, almost in constant currency terms, everybody has grown, the revenue in dollar term at around 4%. You know, Believe me, about 15 years back or 20 years back, they used to grow at 40%. 40% was a norm. Now 4% has become norm. In fact, that with the maintain, that will be great. So the point is that, on such a larger base, it is very difficult to grow. And then the global economic environment is also not conducive for IT sector to lift the revenue growth in dollar term. So therefore, at best, one can have a little exposure to large IT stocks only from defensive point of view. So I've been maintaining the stance for last 3 years that the wealth creation opportunity in the large IT stock is over. At least for another 1, 2, 3 years, you are not going to see unless there is any dramatic technological change or innovation which favors back these large IT stocks. You are not going to make a lot of wealth from these stocks. However, one can look at small and mid-sized quality IT stocks without losing the valuation comfort, because I may be wrong, but I have a firm view that what has happened from 2014 to 2018-19 is likely to repeat, because these large IT stocks are still sitting on a lot of free cash. Two, because of the taxation, the buyback has become unattractive for a large IT stock. So they are not likely to use the cash for buyback, and they are not increasing the dividend phenomenally in the absence of buyback. On the other hand, as I mentioned, they are growing only at around 3 to 4% in dollar term. So which would mean they can look at the inorganic route to grow, that is through acquisition and merger. That's what exactly happened in 2014 to 2019. There are more than 5, 6 companies were taken over, consolidated, or acquired. Starting from Patni Computer to Polaris to Emphasis, many companies were acquired or consolidated. So I am expecting that kind of thing to happen again. So therefore, I am focusing on mid-sized IT companies like Cyient. Personally, I do not own directly or indirectly any stake in Cyient, but that is one stock I keep recommending very firmly, because it is cheapest in terms of valuation, P multiple or enterprise value to annual IT revenue. And secondly, it is well diversified technology company, because on a consolidated basis, it has got IT services and engineering business through Cyient DLM, and also it has got a 100% new subsidiary for semiconductor related business. So my approach is to look for mid-sized IT companies which give you a lot of valuation comfort. That is what I would recommend within the IT space.
If you like the video, do like, comment, share and subscribe.